Welcome back, everyone, to the Deep Dive. Today, we're diving into active fixed income ETFs,
Oh, yeah.
using some great information from Rowe Price to guide our conversation today.
Sounds good.
So, passive investing has really dominated the conversation over the last, decade or so.
Yeah.
And, but Rowe Price is really making the case for active management, particularly in the bond world.
Yeah, they're kind of pushing back against the tide a little bit. It's pretty interesting.
Yeah. So I think before we get into the nitty-gritty, let's just take a step back.
Sure.
Can you remind us what the fundamental difference is between a passive and an active ETF, particularly when we're talking about fixed income?
Well, I think a good way to think about it is,
Okay.
A passive fixed income ETF is essentially a bond index tracker.
Okay.
So, it aims to replicate the performance of a specific bond index.
Right.
So you could think of like the Bloomberg U.S. Aggregate Bond Index. It's kind of like if you were building a model airplane and you were meticulously following the instructions. Okay. The index is your blueprint, and you're just trying to recreate it as precisely as possible.
Makes sense. But Rowe Price is suggesting that it's not quite as straightforward as it sounds.
Yeah, that's right.
Right. They're saying that there are some challenges inherent in this replication process.
Yeah, particularly with bonds.
Okay.
Because the bond market, unlike the stock market, has, thousands and thousands of bonds, many of which don't trade that frequently. So to try to replicate a bond index perfectly, it's like a logistical nightmare.
I can imagine.
Yeah, and quite costly.
Right.
So, it's like trying to find all the pieces for that model airplane. But some are rare and hard to come by.
Yeah, that makes sense. So it's not as simple as just like buying all the bonds in the index.
Right.
So what are some of the implications then of this difficulty in replication?
Well, it can lead to what's called tracking error, which is basically the difference in performance between the ETF and the index it's supposed to be tracking.
Right.
So if the ETF can't perfectly match the index because of these liquidity and trading challenges, then its performance might deviate.
Right, and not always in a favorable way.
And not always in a favorable way, that's right.
Okay, so that's an important point for investors to consider.
Yeah.
It's not just about the index itself. It's also about, how well the ETF can actually track it.
Absolutely. And I think that's really where the idea of active management comes in.
Okay.
Rowe Price would say that active managers can kind of exploit these inefficiencies in the bond market to their advantage. And they can be more selective about the bonds they hold, focusing on those with better liquidity and potentially greater upside.
Okay.
So it's like, that expert model airplane builder who knows where to find the best pieces and maybe even make some custom modifications to improve the design.
Okay, so it's about flexibility then. Right. But doesn't that flexibility also come at a cost?
Yeah, that's right.
I mean, we often hear about the higher fees associated with active management.
That is a valid concern.
Right.
Active ETFs do tend to have higher expense ratios than their passive counterparts. But the key question is that extra cost justified by the potential for outperformance?
Okay. Yeah.
It's like paying a premium for that expert airplane builder. Are their skills and knowledge worth that extra expense?
Right. Yeah, it's a trade-off that investors really need to think about.
Exactly.
Higher fees can really eat into returns.
Yeah, they can.
So the potential for outperformance needs to be significant enough to compensate for that.
Precisely. I mean, Rowe Price would say that in the fixed income market, the potential for what they would call alpha, that's the excess return above the benchmark, can be substantial enough to justify the fees.
Okay, so they're making a bold claim here.
Yeah.
Right. But how do they actually try to achieve this alpha? What's their secret sauce?
Well, they have kind of a multifaceted approach.
Yeah.
First, they emphasize rigorous security selection.
Okay.
So their portfolio managers don't just blindly follow the index.
Right.
They delve into individual bond analysis, assessing, credit quality, interest rate sensitivity, and other factors to identify bonds that they believe are undervalued.
Right.
Or have better prospects than others in the index.
So it's about really using their expertise to kind of cherry pick the best bonds, not just settling for what's in the index.
Exactly. They're not just replicating the index. They're trying to beat it.
Right.
And to do that, they combine fundamental analysis with macroeconomic insights and quantitative modeling.
Okay.
So they're looking at the big picture, economic trends that might affect bond yields.
Right.
And they're also using, sophisticated algorithms to identify potential opportunities.
So they're blending human judgment with the data-driven analysis.
Yeah, that's right.
Okay, so it's a hybrid approach.
Yeah.
But Rowe Price also suggests that passive ETFs face other challenges beyond just these replication issues. Right. They claim that passive funds lack the flexibility to adapt to changing market environments.
Right, they do.
Can you elaborate on that a little bit?
Absolutely. So, passive funds are essentially locked into a predetermined set of holdings.
Okay.
Based on the index.
Yeah.
Let's say there's a sudden shift in interest rates or an economic downturn affecting a particular sector. A passive ETF's just going to continue to hold those bonds regardless of the changing circumstances. It's like our model airplane builder sticking to the instructions even though the wind conditions have changed dramatically.
Yeah, it's like being on autopilot when you really need to take manual control.
Exactly.
Right.
Exactly. Active managers, on the other hand, they have the discretion to adjust their portfolios based on their outlook.
Right.
If they see trouble brewing in a particular sector or anticipate a shift in interest rates, they can reduce exposure to those areas and potentially protect their investors from losses.
So it's about being nimble and responsive, kind of making adjustments as needed.
Right.
But doesn't that also introduce the risk of human error?
Oh, of course.
Right.
Yeah, I mean, active managers are still human, right?
Yeah.
They can make mistakes in judgment.
Absolutely. Yeah. So it's a balancing act.
It is.
Active management has the potential to outperform.
Yeah.
But it also has the potential to underperform.
It does.
Because of that human judgment.
Yeah. And that's why it's crucial to carefully evaluate the track record and expertise of the portfolio managers behind an active ETF. It's like choosing a pilot for your flight, right? You want someone with experience, a good safety record, and the ability to handle unexpected turbulence.
That's a great analogy.
Yeah.
Okay, so we've kind of established here that Rowe Price believes that active management can offer some potential advantages in the fixed income world. But they're not just talking in generalities here.
No.
They have specific ETFs.
They do.
Right, that are designed to kind of put these ideas into practice.
That's right.
So I'm really eager to dive into those examples.
Yeah, let's do it.
And see how these concepts play out in real-world investing.
So Rowe Price highlights 6 of their actively managed fixed income ETFs.
Okay.
In this document, each one is designed to address a specific investor need or market opportunity. So let's start with one that might appeal to investors seeking higher yields.
Okay.
Even if it means taking on a bit more risk.
Sounds intriguing. Tell me more.
It's the floating rate ETF.
Okay.
Ticker symbol TFLR.
TFLR, got it.
This ETF focuses on floating rate debt securities.
Okay.
Primarily bank loans.
Okay.
With below investment grade credit ratings.
So we're venturing into the realm of high yield debt here.
We are.
Okay. What's the rationale for focusing on bank loans specifically?
Well, bank loans, particularly those made to companies with lower credit ratings, tend to offer higher yields.
Okay.
Because they carry more risk.
Right.
But here's the interesting part.
Yep.
The interest rates on these loans are typically tied to a benchmark rate, such as LIBOR, and they adjust periodically.
So if interest rates rise, the income generated by these loans should also increase.
That's right.
Providing a potential hedge against inflation.
Exactly. That's the key advantage of floating rate debt.
Okay.
It can act as a buffer against rising interest rates, which can erode the value of fixed income securities.
That's a valuable feature in today's environment where, inflation is still a concern.
It is.
But you mentioned that these loans are below investment grade.
Yeah.
Meaning they carry a higher risk of default.
That's right.
How does Rowe Price manage that risk within this TFLR ETF?
Well, they emphasize diversification.
Okay.
So the TFLR ETF holds a portfolio of 125 to 150 different bank loans.
Wow. Okay.
Spreading the risk across a variety of borrowers and industries.
So it's about spreading the bets, so to speak?
Exactly.
Putting all their eggs in one basket.
That's right.
Diversification is a fundamental principle of risk management.
It is.
Okay.
And Rowe Price would argue that their active management approach allows them to be even more selective within this universe of bank loans.
Yeah.
They're not just buying any bank loan.
Right.
They're focusing on those they believe have the strongest fundamentals.
Right.
And the best potential for repayment.
Okay.
Even within the high yield category.
So they're applying their credit analysis expertise to kind of identify the most promising loans within this higher risk, higher reward segment of the market.
Exactly.
Okay.
And they're constantly monitoring the portfolio, making adjustments as needed to respond to, changing economic conditions or credit events.
So being proactive, not reactive.
Right.
Okay, so TFLR is designed for investors who are comfortable with some risk and are seeking those higher yields with that potential inflation hedge.
Yeah, that's a good summary.
What about investors who are looking for more of a core bond holding?
Okay.
Something that might track a broader benchmark, like the Bloomberg U.S. Aggregate Bond Index.
Right.
Does Rowe Price have an active ETF for that?
They do. It's called the QM U.S. Bond ETF.
Okay.
Ticker symbol TAG-GI.
TAG-GI. Okay, so this one is going head-to-head with the big leagues, so to speak.
It is.
Aiming to outperform the most widely followed bond index in the U.S.
That's right.
What's their strategy?
It's all about what they call selective replication.
Okay.
So TAG-GI holds a portfolio of U.S. dollar-denominated bonds that represent the key characteristics of the Bloomberg U.S. Aggregate Bond Index. But it doesn't hold every single bond in the index.
So they're being strategic about which bonds they include.
Yes.
How do they decide which ones to pick?
Their portfolio managers use a quantitative model.
Okay.
Hence the QM in the name,
right,
to analyze the index and identify bonds that they believe offer the best combination of potential return and risk.
So it's about finding those little edges that can add up over the long run.
That's the idea.
But how can they be sure that their model is going to consistently outperform the index?
Right.
Markets are unpredictable.
There are no guarantees, of course.
Right.
But T. Rowe Price has a long history of active management, and they backtest their models extensively to see how they would have performed in various market conditions.
So they're not just relying on a gut feeling.
Yeah.
They're using data and historical analysis to inform their decisions.
Yeah, that's right. It's all about having a disciplined process.
Okay.
Combining quantitative analysis with, human oversight.
Okay, so TAG is for investors who want exposure to the broad U.S. bond market, but are looking for that potential for slightly higher returns than a passive index fund.
Precisely. And they believe that their active management approach, particularly in a vast and complex market like the U.S. bond market, can deliver that extra value.
It's an interesting proposition.
It is.
Okay, we've covered TFLR, which focuses on higher yielding floating rate bank loans.
Yep.
We've covered TAG, which aims to outperform the U.S. Aggregate Bond Index. What other flavors of active fixed income ETFs does T. Rowe Price offer?
Let's move on to one that offers more flexibility.
Okay.
It's called the Total Return ETF, or TOTR for short.
TOTR. Okay, total return. That sounds promising?
It does, doesn't it?
What's the strategy here?
So TOTR casts a wider net.
Okay.
It invests in a diverse portfolio of bonds and other debt instruments. Think of it as having more flexibility to adapt to different market conditions.
Got it.
So unlike TAG, which focuses on replicating a specific index, TOTR has a broader mandate.
Okay.
So the portfolio managers can invest across a range of fixed income sectors, including government bonds, corporate bonds, mortgage-backed securities, even emerging market debt.
Wow. Okay.
Yeah, so they really have a lot of flexibility.
So it's a more go-anywhere approach then.
It is.
Giving the managers freedom to adjust the portfolio based on their outlook for various sectors, interest rate environments.
Exactly. And they use a combination of fundamental analysis, macroeconomic research, and quantitative modeling to make those allocation decisions.
So they're looking for the best opportunities across the global bond market.
Yeah, that's right.
Not just within a specific index or sector.
Right.
It sounds like a more opportunistic approach than
it is.
Seeking to capitalize on market inefficiencies wherever they may arise.
That's a good way to put it. It's about being nimble and responsive.
Okay.
Adjusting the portfolio as needed to navigate a constantly changing market landscape.
So this approach seems well suited for investors who are comfortable with a bit more volatility.
It is.
And are looking for a more dynamic bond strategy.
Yeah. TOTR is not for the faint of heart.
Okay.
It can experience wider swings in value
right.
than a more focused or index tracking ETF. But for investors who believe in the value of active management and are seeking that potential for higher returns, TOTR offers a diversified and adaptable approach.
It's like giving the portfolio managers the keys to a sports car.
Right.
And letting them navigate a winding road.
Yeah.
It can be an exhilarating ride.
It can.
But it requires skill and experience to handle those twists and turns.
That's a great analogy.
Okay, let's shift gears now and talk about an ETF that's specifically designed for investors who are seeking those higher yields.
Okay.
Even if it means venturing into the realm of lower-rated bonds.
Right.
High yield means higher risk, but potentially higher rewards as well.
Right.
What's this ETF all about?
It's called the U.S. High Yield ETF.
Okay.
Ticker symbol THYF.
THYF. Okay.
As the name suggests, this ETF focuses on high-yield bonds,
Okay.
also known as junk bonds.
Right, junk bonds.
These are bonds that are rated below investment grade by credit rating agencies.
So we're talking about companies that are perceived as having a higher risk of defaulting on their debt obligations.
That's right.
Why would an investor willingly take on that risk?
Because higher risk often comes with the potential for higher returns.
Okay.
High-yield bonds typically pay higher interest rates to compensate investors for taking on that additional risk.
Right, so there's a risk premium.
Exactly. Think of it as a risk premium.
But isn't investing in high-yield bonds a bit like playing with fire?
It can be if you're not careful.
Okay.
And that's really why active management can be particularly valuable in this space.
Okay.
So Rowe Price's portfolio managers conduct rigorous credit analysis on each bond issuer, really digging deep into their financials, industry dynamics, management teams to assess their ability to repay their debt.
So they're not just blindly buying any high-yield bond.
No.
They're being selective.
Yeah.
Choosing those they believe have the best chance of surviving and thriving.
That's right.
Even in challenging economic conditions.
Yeah. Exactly. They're looking for what you might call diamonds in the rough.
Okay.
Those bonds that are mispriced by the market and offer the potential for attractive risk-adjusted returns.
It's like being a treasure hunter, sifting through the sand to find those hidden gems.
I like that analogy.
But this type of investing isn't for everyone.
Oh, definitely not.
Right.
High-yield bonds are more volatile than investment-grade bonds.
Right.
And they can be particularly sensitive to economic downturns.
Yeah.
So investors really need to have a strong stomach for risk and a long-term investment horizon.
It's not a place for conservative investors or those who need quick access to their capital.
I agree with that. But for investors who are comfortable with the risks and are seeking higher yields, THYF offers a way to access this potentially rewarding segment of the market with the added benefit of active management and diversification.
All right. We've covered ETFs that focus on floating rate bank loans.
Yeah.
Broad U.S. bonds. A total return approach.
Right.
And now high-yield bonds. What other niches does Rowe Price cover
Okay. So
with their active fixed income ETFs?
let's talk about an ETF that appeals to investors seeking stability and income with minimal interest rate risk.
All right, I like the sound of that.
It's called the Ultra Short-Term Bond ETF.
Okay.
Ticker symbol TBUX.
TBUX, okay. Ultra short term.
Yes.
Suggests we're talking about bonds with very short maturities.
We are?
How short are we talking?
We're talking about bonds with maturities of less than 1 year.
Wow, that's really short.
It is.
What's the advantage of investing in bonds with such short maturities?
The main advantage is that they are less sensitive to changes in interest rates.
Right.
When interest rates rise.
Yeah.
The value of longer-term bonds tends to fall more sharply than shorter-term bonds.
That makes sense. It's like the difference between a speedboat and an ocean liner.
Right.
The speedboat can change direction quickly. The ocean liner takes a lot longer to turn.
Exactly. So in a rising interest rate environment, ultra short-term bonds can provide a haven of stability.
Okay.
They're less likely to experience significant price fluctuations.
So TBUX is for investors who are primarily concerned about preserving capital, generating income, even if it means accepting lower yields.
Right. It's a more conservative approach to fixed income investing.
Okay.
And Rowe Price would argue that their active management approach can add value, even in the short-term segment of the market. You know, they're constantly analyzing the market, looking for the best opportunities among a universe of short-term debt securities.
So they're not just passively holding a basket of short-term bonds.
No.
They're actively making decisions about which ones to buy and sell based on their outlook for interest rates, credit risk, and other factors.
Exactly. It's about seeking to maximize returns while minimizing risk, even within a relatively low-yield environment.
Okay, we've got one more ETF on the list. Bring it on.
Last but not least, we have the Intermediate Municipal Income ETF.
Okay.
Tax E.
Tax E. That sounds interesting, especially as we approach tax season.
It does, doesn't it?
What's the focus here?
This ETF zeroes in on investment-grade municipal securities.
Okay.
So that means bonds issued by state and local government.
Ah, so there's a potential tax advantage here.
Exactly. The income generated from these municipal bonds
Okay.
is often exempt from federal income taxes.
Okay.
Now, there might be state and local taxes to consider,
Right.
depending on where you live and the specific bonds held by the ETF.
Yeah, it can get a little complicated
It can.
with state and local
It
taxes.
can.
But the federal tax exemption
Right.
is a pretty big deal.
It is. For investors in higher tax brackets,
Right.
that tax-free income can be a significant benefit.
Yeah, so taxi could be a good option for investors who are looking for that tax-efficient income,
Uh-huh.
especially those in higher tax brackets.
Exactly.
But municipal bonds aren't without risk, right? I mean, we've heard stories about cities and states facing financial difficulties.
Yeah, you hear those stories.
So how does Rowe Price mitigate that risk within the taxi ETF?
They have a team of experienced municipal bond analysts
Okay.
who conduct in-depth research on each issuer,
Mm-hmm.
evaluating their financial health, economic prospects,
Right.
management practices.
Okay.
They're really looking for bonds that offer a balance of yield and credit quality.
So they're not just buying any municipal bond.
No.
They're being selective.
They are.
Choosing those they believe have the strongest fundamentals
Yes,
and the lowest risk of default.
precisely. And they're constantly monitoring the portfolio,
Yeah, okay.
making adjustments as needed based on their ongoing research
Uh-huh.
and assessment of the municipal bond market.
So they're taking a very hands-on approach
Yeah, they are.
to managing this ETF,
They are.
leveraging their expertise
Yes,
to identify the most promising opportunities within the muni bond market.
that's right. And they believe that their active management approach can deliver
Okay.
consistent tax-efficient income while minimizing credit risk
Okay.
for investors seeking that type of exposure.
Wow, that was quite a lineup.
It was.
We've covered 6 different ETFs from Rowe Price,
Yeah.
each with its own unique characteristics
Uh-huh.
and investment strategy.
Mhm.
What do you think stood out to you the most from those examples?
What I find particularly interesting is how Rowe Price has constructed a suite of ETFs
Okay.
that cater to a variety of investor needs and risk tolerances.
Right.
You know, whether you're seeking higher growth potential,
Yeah.
income generation, tax efficiency, there seems to be an actively managed ETF
Yeah.
that could fit the bill.
Yeah, it's like they've created a diverse menu of fixed income options
I have.
that allow investors to pick and choose what aligns best with their goals
Uh-huh.
and comfort levels.
Oh,
I want to circle back to something you mentioned earlier
okay.
about alpha.
Uh-huh.
Rowe Price makes a big deal about the potential for alpha
Yes.
with their active ETFs. Can you explain a little bit more
Yeah,
what alpha means in the context of fixed income investing
sure.
and how active managers actually try to achieve it?
Sure. So alpha, in simple terms,
Yep.
is the outperformance of an investment compared to its benchmark.
Got it.
So if, say, the Bloomberg U.S. Aggregate Bond Index returns 5% in a given year,
Uh-huh.
and an active ETF like TAG returns 7%,
Okay.
that extra 2% would be considered alpha.
So it's the value that the active management is bringing to the table,
Exactly.
the potential to get returns that exceed what you would have gotten
Right.
if you just invested in a passive index fund.
That's the idea.
Okay. And in the world of fixed income, where returns can be, relatively modest,
Yeah.
that extra percentage point or two of alpha
Right.
can make a significant difference over time.
It can, especially when you consider the power of compounding.
Right, compounding. The gift that keeps on giving.
It is.
But achieving consistent alpha isn't easy, is it?
No, it's not.
I mean, it's not like active managers have a magic formula.
No magic formula, unfortunately.
So how do they try to achieve this alpha?
Well, they employ various strategies.
Okay.
One common approach is what's called sector rotation.
Okay, sector rotation, what does that involve?
So that involves shifting the portfolio's allocation
Right.
among different sectors of the bond market,
Uh-huh.
such as government bonds, corporate bonds,
Right.
mortgage-backed securities, emerging market debt.
Okay.
So, for example, if a manager believes that corporate bonds are poised to outperform government bonds,
Okay.
they might increase their exposure to corporate bonds
Right.
and reduce their holdings of government bonds.
So it's about anticipating which segments of the market are likely to perform better,
Exactly.
and then positioning the portfolio accordingly.
That's right. Okay. Another key strategy is security selection.
Right. We touched upon that a little bit earlier.
Yeah, we did.
So that's the art of choosing individual bonds within a particular sector or index.
Right.
Requires in-depth credit analysis.
It does.
Right. Assessing the financial health of each bond issuer.
Yeah, you got to really dig deep.
And evaluating that potential for default.
Absolutely. So it's like being a discerning bond shopper.
It is. You're picking the best bonds from the bunch.
Picking the best bonds from the bunch. I like that.
Okay. And active managers also use duration management.
Yeah, that's an important one.
To try to enhance returns.
Right.
Duration, for our listeners who might not be familiar, is a measure of a bond's sensitivity to changes in interest rates.
Exactly.
Right. So
Yeah.
we talked about that earlier in the context of the ultra short-term bonds.
Right.
Those have very low duration.
Yeah.
Because they're less affected by interest rate movements.
That's right.
So if a manager anticipates that interest rates are going to rise, they might shorten the duration of the portfolio
Exactly.
by selling those longer-term bonds and buying shorter-term bonds.
That's right.
And that can help to mitigate the potential for losses as interest rates climb.
Exactly. So duration management is kind of like adjusting the sails on a ship.
It is.
To navigate changing winds.
Right. You're trying to kind of be proactive and position that portfolio to weather the storm.
That's a great way to think about it.
So those are just some of the tools that active managers use.
Some of the tools,
to try to generate that alpha. But as with any strategy, there are risks involved.
Oh, absolutely. There's no guarantee of success, right?
Yeah, there's no guarantee.
Active managers can make mistakes.
They can. They're human.
Their predictions can be wrong.
Right.
And sometimes the market just doesn't cooperate.
Right. Sometimes it just has a mind of its own.
Exactly.
So active management isn't a foolproof system.
It is not.
But T. Rowe Price believes that, their experienced portfolio managers, the rigorous research process, and that disciplined approach give them an edge in seeking that consistent outperformance over time.
That's their belief.
Okay, so we've explored the potential benefits of active fixed income ETFs.
We have.
But it's also important to acknowledge the potential downsides.
It is.
Right, we talked about the fees earlier.
Yeah, those higher fees.
But what are some other factors investors should consider?
Well, as with any investment, there are risks to consider.
Yeah.
One key risk with active ETFs is the potential for underperformance.
Okay.
Even the most skilled managers can have periods where their strategies don't work as expected.
Right. So there's no guarantee that an active ETF is going to beat its benchmark.
Right. Exactly.
Or even a comparable passive ETF.
That's true.
Okay. And another risk is what's called style drift.
Style drift, yeah.
So this is where a manager might deviate from their stated investment style.
Right.
Or strategy.
Exactly.
So for instance, an ETF that was initially focused on high-yield bonds might start investing in more investment-grade bonds.
Yeah, and changing its risk profile.
Right. And that could potentially disappoint investors.
It could.
Who were expecting a certain type of exposure.
Yeah, that's why transparency is so important.
It is.
T. Rowe Price has a robust system in place to monitor their managers.
Okay.
And ensure they're adhering to their stated strategies. And they also provide transparency to investors through regular communications, portfolio updates.
That's good to hear. Transparency is crucial in the world of active management.
It really is.
Because investors need to understand what they're investing in, how their money is being managed.
Exactly. And it's also important for investors to remember that past performance is not indicative of future results.
Right. Past performance is not a guarantee.
Right. Just because an active ETF has outperformed in the past doesn't mean it'll continue to do so in the future.
So do your research, understand the risks involved.
Absolutely.
And choose ETFs that align with your investment goals.
Right.
And risk tolerance.
Couldn't have said it better myself.
All right. So we've delved deep into the world of active fixed income ETFs. Guided by the insights from T. Rowe Price.
A great guide.
We've learned about the potential benefits, the risks involved, the various strategies that active managers employ to try to generate that alpha. What's the key takeaway?
Well, I think the main takeaway is that active ETFs offer a potentially compelling alternative to passive strategies in the fixed income market. You know, they provide greater flexibility, in-depth research, and the potential for outperformance. But remember,
Yes.
there are always risks involved.
Right.
It's essential to do your research
Yes.
and make sure any investment aligns with your specific goals and risk tolerance.
Well said. It's all about making informed decisions,
It is.
weighing the potential rewards against those potential risks,
Uh-huh.
and choosing investments that fit your individual circumstances
Right.
and investment philosophy.
Yeah, active ETFs certainly have a place
They do.
in a well-diversified portfolio.
But they're not a magic bullet. And they're not right for everyone.
Not for everyone. That's a great point.
It's not about active versus passive. It's about choosing the right tool for the job.
That's it.
And sometimes the best tool might be a combination of both approaches.
Absolutely.
So there's no one-size-fits-all solution in the world of investing.
Nope.
It's about finding what works best for you.
It is.
And I hope this deep dive has provided our listeners with the knowledge and insights they need
I hope so too.
to make those informed decisions. If you are intrigued by the potential of active fixed income ETFs,
Uh-huh.
we encourage you to explore Rowe Price's website, consult with a financial advisor,
Yeah.
and continue your own research.
Knowledge is power.
Knowledge is power, especially when it comes to your financial well-being.
Especially when it comes to your financial well-being.
Well, that brings us to the end of our deep dive into active fixed income ETFs.
It does.
I want to thank you, our expert guest, for sharing your insights
It was my pleasure.
and for guiding us through this really complex topic.
Happy to do it.
And to our listener, thank you for joining us on this journey of discovery.
Yes. Thank you.
We hope you learned something new
Uh-huh.
and feel empowered to navigate the world of fixed income investing. Until next time,
Until next time.
keep exploring, keep learning, and keep diving deep.